In the summer of 2011, not long after the Republicans took control of the House of Representatives, during the third year of the last Democratic president, almost exactly the same as the setup right now, we had the same debt ceiling showdown. Our government went past the ceiling. Treasury took special measures to stretch out the cash. You've heard about all these things, right? But you know what? It really came down to the wire. And one of the major ratings agencies downgraded the United States credit rating thanks to risk of a totally voluntary default. Voluntary. They went over the line in mid-May, and they had enough money to make it through to early August, but then the negotiations between Congress and the White House went nowhere, just like right now. From the May highs to the August lows, the S&P 500 lost nearly 20% of its value. 20%! Of course, not all of that was the debt ceiling. Europe was having a horrific sovereign debt crisis, but it really was just the inability to make a deal. However, there was a two-week stretch in late July, early August, where the market got eviscerated by the looming risk of the federal government defaulting on its obligations. During that period, in a completely ill-advised move, the S&P plunged more than 17%. To put that in perspective, during the entirety of last year, the S&P fell 19.4%. But everyone was panicking. And it felt terrible. Just imagine if we had a similar decline over the span of a couple of weeks. Of course, the last debt ceiling crisis eventually did get resolved. The Obama administration and the House Republicans agreed on some spending cuts. The debt limit got raised in early August. Problem solved. And here's the thing. Once the situation stabilized, the stock market bounced back very quickly. In fact, the S&P 500 finished 2011 more or less flat for the year. What a buying opportunity. Despite the Eurozone sovereign debt crisis and the Fukushima nuclear disaster and the U.S. government nearly defaulting on its obligations, our stock market was barely dinged by the end of the year. Boy, I remember that period. People just told me I was way too bullish after the debt ceiling agreement. I said, no, that was the problem. I think it's a major reason why nobody seems to be freaking out now, though, about the current debt ceiling fiasco. Fool me once, shame on you. Fool me twice, shame on me.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.